This video provides beef producers a general overview of the risk management tool, Livestock Risk Protection Insurance, commonly referred to as LRP. Presenters include Heidi Kirkland, Risk Management Specialist for the USDA Risk Management Agency in St. Paul Regional Office, Brenda Boetel, Agriculture Business Professor at UW River Falls and UW-Madison Division of Extension Commodity Marketing Specialist, and myself, Bill Halfman, UW-Madison Division of Extension State Beef Outreach Specialist. Topics that will be covered in this video include an overview and general information on livestock risk protection, some details on the feeder calf and fed cattle coverages, and an example situation using the feeder calf coverage. Heidi will discuss the overview and general information.
Hi, my name is Heidi Kirkland, and I am a risk management specialist for the USDA Risk Management Agency at the St. Paul Regional Office, proudly serving the producers of Iowa, Minnesota, and Wisconsin. Today we're going to be talking about the Livestock Risk Protection Program, or LRP. The LRP program offers coverage for feeder cattle, fed cattle, and swine. But this presentation is specifically tailored for cattle producers only. I will be going over recent improvements and modifications and an overview of the program. Livestock Risk Protection. What is it? LRP is an insurance program designed to protect producers against declining market prices. Producers may choose from a variety of coverage levels and insurance periods that match the time their cattle would normally be marketed. Insureds may choose coverage levels ranging from 75 to 100% of the expected ending value. At the end of the insurance period, if the actual ending value is below the coverage price, an indemnity will be paid for the difference between the coverage price and actual ending value. There were a lot of improvements and modifications to the LRP program for the 2026 crop year. The following slides will cover an overview of the changes. There were 2 new types of livestock added. These include adding dairy cull cows to the fed cattle type and adding unborn beef and beef on dairy calves to the feeder cattle type. The yield grade requirement for fed cattle was also removed, and both the premium billing and termination dates were changed. Additional improvements and modifications include allowing coverage based on a forward contract or purchase agreement, even if the livestock are not yet in the insured's physical possession, as long as the agreement was executed before the insurance period began. Also, with a livestock purchase agreement, the insured is required to take possession of the covered livestock no later than 90 days prior to the SCE end date. With these new improvements, additional record requirements now include providing a copy of both the purchase agreement and the delivery receipt, showing the date of delivery and the weight of the covered livestock. Modifications were made to the requirements to receive an indemnity. Insureds must provide documentation verifying the sale of the covered livestock during the insurance period, or no later than 60 days after the end date of the SCE. This documentation must show the insured as the seller, the purchaser, the date sold, the sex of the livestock, the number of livestock sold, and the average weight of the livestock sold. There are special requirements for feeder cattle types, and we'll discuss those on the next slide. Improvements and modifications specific to feeder cattle are that we now require marketing records to include the sex of sold livestock with penalty adjustment if marketing records differ from what was indicated on the SCE. There are now additional record requirements for when livestock are purchased but not marketed within 60 days of the end date of the SCE. And lastly, we added a drought hardship exemption that will be based on the Drought Monitor's Drought Severity and Coverage Index. We added a definition and language that outlines what subsidy capture is and specifies that subsidy capture is not allowed. Also included in this new section are examples of what is considered subsidy capture. We provided flexibility for insureds to assign an indemnity to a single payee, like a creditor, if agreed upon in writing. We're now going to cover an overview of the program. LRP uses the Chicago Mercantile Exchange, or CME, to determine the actual ending values based on weighted average prices. Actual ending values are posted on RMA's website at the end of the insurance period. The premium billing date is now the first day of the second month following the end date of the SCE. Premium subsidies range from 35 to 55% based on the coverage level selected. LRP does not cover death loss. However, if insureds do have a loss, they should notify their agent within 72 hours to update the number of livestock covered on the endorsement to ensure accurate premium and revenue calculations. Insureds should determine when and how many specific coverage endorsements they will need. The insured should determine a time frame when their livestock typically reach their target weight and are marketed and sold, and count the number of weeks until that date to determine the length of endorsement needed. Endorsement lengths range from 13 to 52 weeks at 4 to 5 week intervals, with one exception being dairy cull cows. Each SCE will contain the following information: the effective date of coverage, the number of livestock to be covered, the type, the target weight, along with the end date, coverage price selection, coverage level, and ownership share. Beef producers can purchase an LRP policy through a livestock insurance agent by first submitting an application for coverage with the agent. The application ensures eligibility to participate in the program and determines if qualifications for beginning farmer and rancher or veteran farmer and rancher benefits are met. However, insurance does not attach until the producer buys a specific coverage endorsement, or SCE. Producers can buy multiple SCEs with the one application. Insurance coverage starts the day a producer buys an SCE and RMA approves the purchase. Daily offers can be reviewed on the RMA website. Endorsements can normally be purchased any weekday, excluding holidays. The sales period begins when the coverage price and rates are published on the RMA website, generally around 3:30 p.m. daily, and ends at 8:25 a.m. Central Standard Time the following day. Insureds will need to work with their agent to secure the offer. The crop year is July 1st through June 30th. The effective date, or beginning of coverage, of the SCE determines the crop year. There is an agent locator tool on the RMA website to assist producers in finding a livestock insurance agent in their area. Navigate to the Tools and Reports tab, then choose Agent Locator and click on the link seen on the slide. And this concludes RMA's portion of the presentation. More information to come from Bill and Brenda. Thank you.
We will now get into some of the details on the feeder calf and fed cattle coverages. The purpose of livestock risk protection is to provide a tool for beef producers to help protect the expected market value of their cattle at the time of purchase from unforeseen price declines at the time of sale. Policies are available for feeder cattle and fed cattle. Feeder cattle endorsements are set up in different categories by expected weight range at the time of sale, sex, and breed type. Calves being backgrounded or stocker calves on pasture could be covered with a feeder cattle endorsement. Some categories require that steers and heifers each have their own specific coverage endorsement, while other categories do not. Work with your insurance agent to determine the correct category based on the type of cattle you have and expected ending weight. Feeder cattle expected ending values are determined from feeder cattle futures prices. By definition, feeder cattle futures contract prices represent steers weighing 700 to 899 pounds with number 1 and number 2 muscle. The CMA feeder cattle index is also based on the same type of cattle as the futures contract. Price adjustment factors are used to account for differences between the type of steers that futures contract prices represent and other types and weights of feeder cattle. The adjustment factors are used to calculate the expected ending values, coverage prices, and actual ending values prior to being published by the RMA. The premiums are also reflective of the type of cattle that the specific coverage endorsement is for. The actual ending value is determined from the CME Feeder Cattle Index, which is a 7-day weighted average of actual sale prices for 700 to 899 pound number 1 and number 2 muscled steers from a specified 12-state region with larger numbers of feeder cattle sales year-round. Wisconsin is not one of those states prices are collected from to determine this index. That said, when prices go up or down within those states used to develop the index, they generally go up or down across the country. This table is an example of 1 day's data collected to determine the CME Feeder Cattle Index. This is used to determine the actual ending value for the feeder cattle specific coverages. Once this information is obtained, then they can calculate the actual ending values for each of the specific coverage endorsements for the different breed and weight categories that end on that day. The same price adjustment factors are used that were used to determine the expected ending values available at the time of purchase. Fed cattle protection is more straightforward than feeder cattle coverage in that there is only one type of coverage endorsement that covers cattle being finished for slaughter. There is no separation by sex or breed base for fed cattle specific coverage endorsement. The producer needs to select the ending time frame or length, expected weight, number of head, and the percentage of coverage of the expected ending value that they would like to have coverage for. Fed cattle expected ending values are determined from fed cattle futures contracts. Fed cattle actual ending values are determined from the 5-area weekly weighted average direct slaughter cattle report. Again, note that Wisconsin is not one of the states where prices are collected from for this report. However, Wisconsin's price tends to move in the same direction as the 5-area weekly price. Daily coverage prices for the various categories and lengths of endorsements can be found at the link listed on this slide. The user will have to select appropriate categories to get the specific coverage endorsement report of interest generated. The pictures on this slide are rows from 2 different daily report tables showing examples of coverages offered with the associated information for feeder steers and feeder heifers offered on April 25th, 2024. The report contains the coverage prices offered for the different coverage levels, the cost, and the actual producer premium. Once the contracts have come to the ending date, the actual end value is posted. Until that time, the final column showing the actual ending value will be blank.
Hello, my name is Brenda Boetel, and I'm a professor of agricultural business at the University of Wisconsin River Falls and a commodity marketing specialist for University of Wisconsin Extension. I'm going to walk through a specific livestock revenue protection example here in the next few slides. For our example, we will assume the following situation. It is April 25th. Sarah is a cow-calf operator with 60 cows. She has 28 bull calves and 26 heifer calves on the ground and plans to sell all bull calves as steers and keep 12 heifers as replacements, giving her 14 heifers to sell. She plans on weaning in mid to late October and marketing the calves in approximately 32 weeks in early December at approximately 580 pounds for the steers and 530 pounds for the heifers. To use LRP, she would need to have a policy for feeder cattle for steers for weight 1 under 600 pounds and a second feeder cattle policy for heifers weight 1 under 600 pounds. Sarah will need to determine her protection level. To do so, she will want to review the USDA website to see the expected ending prices. She will have options for different endorsement lengths and coverage prices. Note that in the chart shown, only select endorsement length and coverage prices for feeder steers that weigh less than 600 pounds at marketing are shown. Assuming it is April 25th, 2024, and Sarah plans to market the animals in 32 weeks, she would look for ending dates closest to her expected marketing date. Note that there is no endorsement length of 32 weeks. In this example, she can choose either an endorsement length of 30 or 34 weeks. The end date of either November 21st or December 19th corresponds with the endorsement length and is the date that the policy will use to determine the ending price. Sarah will pick a date where she can be assured she can market her animals within 60 days on either side of the policy ending date. She does not need to market her actual animals on this date. She has 60 days on either side of the policy ending date to actually market her animals. Once Sarah has determined the endorsement length of the policy, she will need to determine the coverage level. The expected ending values and coverage levels change daily and must be obtained from the RMA website. These coverage levels range from 70% to 100% of the expected ending values. The USDA website will show Sarah expected ending values and coverage levels. There will be many options, but only the highest coverage level for each endorsement length are shown in this example. For the endorsement length of 30 weeks, note that 99.69% of the expected ending value is the highest coverage level available. The expected ending value for steers selling on November 21st is $284.68, and 99.69% of that is a coverage price of $283.80. If the actual ending value on November 21st, 2024 is below $283.80, Sarah would be paid an indemnity. The premium per hundredweight is shown on the chart. If Sarah had chosen an endorsement length of 30 weeks with an ending date of November 21 and a coverage level of 99.69%, she would pay $9.08 per hundredweight of steer insured. For an indemnity payment to be greater than the premium owed, the actual ending value must be lower than the expected ending value by more than the premium. In this example, the actual ending value would have to be below $274.72 for an indemnity to be greater than the premium and Sarah to have a net positive return on the LRP policy. If the actual ending value is between $274.72 and $283.80, the indemnity payment will not completely offset the LRP payment. If the actual ending value is above $283.80, Sarah will receive no indemnity and have to pay the full premium. Note that this chart now shows both steer and heifer information, both with an endorsement length of 30 weeks and a coverage level of 99.69%. As a review, Sarah purchases one policy for feeder steers weighing less than 600 pounds. She insures 28 head with an expected marketing weight of 580 pounds. She expects to market her actual animals within 60 days before or after November 21st, 2024. She chooses a 99.69% coverage level with a premium of $9.08 per hundredweight. Her premium for the feeder steer policy is $9.08 times the 5.8 expected hundredweight times the 28 head of steers insured for a total of $1,474.59, payable on the first day of the second month following the end date for the coverage endorsement. Sarah purchases an additional policy for feeder heifers weighing less than 600 pounds. She insures 14 head with an expected marketing weight of 530 pounds. She expects to market her actual animals within 60 days before or after November 21, 2024. She chose the 99.69% coverage level with a premium of $8.25 per hundredweight. Her premium for the feeder heifer policy is $8.25 times the 5.3 expected hundredweight times the 14 head of heifers insured for a total of $612.15. Now assume that Sarah has one feeder steer die. She made notification to the insurance company within the required 72 hours of the calf's death. She markets her animals at the sale barn on December 20th. The steers weigh an average of 565 pounds and she receives $290 per hundredweight at the sale barn. The heifers weigh an average of 528 pounds and she receives an average of $276 per hundredweight at the sale barn. Note that although the market date is later than the anticipated mid-December date, it is still within the 60 days of the policy end date of November 21st. Remember that the price Sarah received at the sale barn on December 20th does not play into the calculation of her indemnity. USDA determines the actual ending value for steers in the 100 to 599 pound category at 110% of the CME feeder cattle index, and for heifers at 100% of the CME feeder cattle index. Sarah can view the USDA website to see this information. Since her policy has a marketing date of November 21st, the CME index on November 21st was used to determine her actual ending value. The USDA does not use her actual marketing date of December 20th to determine the actual ending value for the insurance. On November 21st, 2024, the CME feeder cattle index was $254.54. 110% of that gives the actual ending value for feeder steers at $279.99. The actual ending value for heifers is simply the CME feeder cattle index price of $254.54. These are the values that will be used in determining if an indemnification is paid. To determine the amount of indemnity paid, the actual ending value for steers of $279.99 is subtracted from the coverage price of $283.80. This difference of $3.81 is multiplied by the expected weight of 5.8 hundredweight times the 28 head insured to get an indemnity of $618.74. Note that although Sarah had one steer die, because she notified the USDA within the 72-hour period, she is still paid the indemnity on this animal. Sarah owes $1,474.59 in premium, and the indemnity is subtracted from this amount, leaving Sarah to pay $855.85. Note that the actual ending value for steers of $279.99 is above the coverage price minus the premium, which was $274.72. For the indemnity owed to Sarah to be greater than the premium, the actual ending value would be lower than the coverage price minus the premium. Sarah will need to provide proof of sale or proof of continued ownership to claim an indemnity payment. Specific details, including number of head of cattle, will be checked against the specific coverage endorsement. The indemnity on Sarah's heifer policy is determined by subtracting the $254.54 actual ending value from the coverage price of $258. This gives an indemnity of $3.46 per hundredweight times the expected ending weight of 5.3 hundredweight times the 14 head for a total of $256.73. Given that Sarah owes $612.15 for the policy, this indemnity is subtracted from the amount she owes to leave her owing only $355.47. Again, note that the actual ending value of $254.54 is above the coverage price minus the premium, which is $249.75. In this example, the indemnity received was less than the premium owed. Remember that LRP is to protect against unexpected price changes. The objective is to set a minimum amount, not accounting for basis changes, that Sarah would receive for her animals should prices take an unexpected downturn. The index price did not dip below the coverage price minus the premium, hence the indemnity will not be greater than the premium owed. This is a good thing, though, as Sarah receives a higher price for all her animals and still have protection against unforeseen lower prices. If the premium had been less than the indemnity, Sarah would have received the remainder of the indemnity amount at this time. Remember that the indemnity is paid based on the expected insured weight, the number of head of cattle insured, assuming any deaths are reported within 72 hours, and the actual ending value determined on the end date of the policy. The indemnity is not based off of actual weights, actual number of head sold, or actual prices received. To summarize, LRP protects producers against unexpected declines in market prices. For more information, contact an agent. An application must be completed prior to the purchase of any specific endorsement. Once an application is approved, a producer can then purchase a specific endorsement, which will need information such as the number of animals, livestock type, target weight, end date, coverage price, and ownership share. Be sure to discuss with an agent the required documentation needed for indemnity collection.
As indicated earlier, the information presented in this video is current as of August of 2025. Occasionally, changes are made to the LRP program. Your insurance agent can answer questions and help you through the processes. For general questions, you may also reach out to Heidi, Brenda, or myself. Thank you for watching.